Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome to the Treasury Update podcast. This is Craig Jeffery, your host today. This is the 2023 Outlook series, and today I'm joined with Tony Carfang from the Carfang Group. Tony, welcome again to the Treasury Update podcast.
Thank you, Craig. Happy to be here. Happy to be in front of your audience.
Yeah, before we get into your outlook, particularly on the inflation and funds and cash, what are some of the things you've been working on lately, or the items that you've been following, and any books that you've been reading, even that you can share with the audience?
Well, I read the history of the Federal Reserve a couple months ago. Great volume talking about all the reasons why we need a central bank in the first place. I'm still not convinced, but it was a fascinating read. Interesting politics back then and a bunch of compromises that gave us the system that we have today. It was a fascinating read. Actually, I've been following the Fed very, very closely. I've been active in the financial regulatory front and looking at helping clients discern what's happening with the inflation and interest rates and the Fed's macroeconomic policy. The Fed has a hugely inflated balance sheet. Central banks around the world have a hugely inflated balance sheet, grown 11-fold since the global financial crisis started 12 years ago. 14 years ago, time flies. But that's a hell of a range of growth. A lot of liquidity in the system that is creating an unstable situation. And so we're watching that very closely for our clients.
Yeah, thanks for that, Tony. We'll put the book in the show notes too, just so people can follow along. As we look out over 2023, maybe a quick recap of 2022, we saw inflation continue, what was supposed to be very temporary, and it became much more permanent. The Federal Reserve has moved kind of in a hyperscale to raise it up a number of 75 basis point increases, ending the year with a 50 basis point increase, trying to tamp down inflation. As you think about 2023, who are you paying attention to? What are you paying attention to the most for 2023?
Well, I'm paying very close attention to the Fed and to other central banks around the world, particularly the major ones, the Bank of England, the European Central Bank, Bank of Japan, all of whom did some tightening over the course of 2022. That tightening, by the way, we don't believe is nearly sufficient to solve the problem. If you look back over the history of inflation, of prior inflations, there's never been any such thing as a transitory inflation. Never. People cite Paul Volcker, the inflation slayer, back in 1980 or 1981. I actually posted a trivia question on my blog several months ago about how long did that last inflation cycle last. I gave four choices, like 20 months, 30 months, 40 months, or 197 months. The answer is D. If you listen to the regulators or if you listen to the monetary policy powers that be, there's no conception that this is going to last for 15 years. But the last one did, and it kept coming back. In the last cycle, there were actually 4 intermediate peaks and then declines until inflation ultimately peaked in 1981. We hit a peak and we're now down for 6 consecutive months. Annualized inflation has fallen 6 months in a row. Craig, in the last cycle, that happened 6 times before inflation hit its ultimate peak. Inflation peaked, had 6 consecutive months of decline, mucked around a little bit, went back up. Another 6 consecutive months. So here we are with our first 6-month decline, and the administration is claiming victory. The markets are claiming victory. The Dow's at 34,000. Bitcoin is going up. And I'm like, guys, let's take a step back here and look at what's really going on. So if you think about it from a macroeconomic level, inflation is simply lack of supply and increase of demand. If you look at what has caused the lack of supply, there are two primary factors that contribute to that. One is supply chain problems. The other is labor shortages. that are causing supply to be constricted, which puts upward pressure on prices from the supply side. Well, the supply chain problems are being resolved. That's the transitory part. But the labor problems, if anything, are becoming even more serious as the labor shortage declines. The unemployment rate is at rock bottom, yet people can't find workers. Job wanted is still not all-time high. The labor market is broken. That needs to be fixed before the supply side of the inflationary pressures abate. Now, if you look at the demand side, we have all of the short-term demand as a result of the COVID-related stimulus, and we seem to still be stimulating, although COVID seems to have kind of reached some sort of equilibrium, whatever the healthcare people call it. That's about to decline, though, the COVID-related stimulus. So that part of the demand equation is likely to abate, so therefore transitory. But the other part of the demand equation is government spending. Well, it's government spending. Governments around the world with deficit spending, the U.S. government with $1.5 trillion, with by 5% of GDP, of excess demand. That's just a lot of excess, and that's just the deficit. That's not the spending. So the government is creating excess demand, and there seems to be, we just saw last month with the budget bill that's in place through October, that excess demand is still in place. That's not transitory. So we still have a substantial supply side problem in the labor market and a demand side problem with federal government deficits. By the way, the Federal Reserve can't control either of those. And that's the issue, Craig. That's the issue confronting treasurers.
Yeah, some of those demand and supply, some of those are the labor force, some of the changes, the retirement of the baby boomers, changing population elements as well. I mean, there's big shifts those aren't changed with a policy, not quickly. Tony, your group, the Carfang Group, puts out the U.S. Cash Letter, Cash Report. I can never remember what the exact title is. We'll put a link in the show notes. Corporate cash has been at pretty high levels since we started COVID. People stocked up on cash. Can you summarize what's been happening with corporate cash and what you expect to occur in 2023? I know some of the things you said are a little foreshadowing of that, but if you could give us a rundown there.
As recently as during the global financial crisis in 2008, corporate cash stood at about $1.5 trillion. And it was growing steadily, but a fairly constant rate relative to GDP. But in 2020, with COVID and all of the stimulus, corporate cash spiked to $4 trillion. That's up from $1.5 trillion in 2008. So, it was about $1.5 trillion above its long-term trend line. It has since retraced about half of that. So corporate cash is now down at about $3.5 trillion, but still several hundreds of billions, close to $1 trillion above its long-term trend line. Corporate treasurers are facing quite a bit of uncertainty. It's one thing when you're borrowing at zero interest to pad your balance sheet with excess cash as a precaution, but at 5, 6, 7%, and for non-rated companies, capital costs higher than that, there's a huge carrying cost for this excess cash. That's a big drag on the economy. We expect some of that excess corporate cash, which is the result of increase in short-term borrowing, to decline as companies choose to deploy that cash by paying down debt. Obviously, there will be some deployment of corporate cash into capital expenditures, plant and equipment, and technology projects. But I think paying down variable rate debt is going to be the primary use. And in 2023, I think treasurers are simply going to take a wait and see attitude. They're going to be minding their capital structure. How much debt should they have on their balance sheet? How much equity? How much liquidity should they be holding? Because they know that they need to navigate the headwinds that are going to be dictated by inflation, inflation reduction efforts, monetary policy, trade issues, trade imbalances, foreign currency. I mean, the dollar, which was soaring in 2022, has fallen 10% from its high. Is it going to bounce back? I think it will, as the Fed decides it needs to continue to tighten, as inflation stops declining as fast as it has been. But we don't know. And the Treasurer's job isn't to gamble. The Treasurer's job is to be defensive, to be the custodian of the company's assets, and therefore maintain sufficient excess cash, subject to reasonable carrying cost.
Any other implications you see for treasurers or treasury groups besides the general stewardship or custodian of the assets? Volatility's been high. Is it going to tamper down? Do we still need to stay in the prepare for the worst kind of approach for FX, interest rates, inflation, supply chain?
I think the good news going into all of this is that banks around the world, and especially in the U.S., are incredibly well capitalized. I mean, we weathered COVID. Banks have been successful in weathering that. The consumer has been strong, in part thanks to all of the stimulus. As that spins down, there's a little more risk out there. But essentially, I think what we're seeing is a decline in volatility over the course of 2023. There's probably going to be one or two shocks earlier in 2023. They're going to smooth out later on. But slowly, as the supply chain problems work themselves out, slowly as the U.S. Congress gets its arms around the budget, economies around the world get their arms around their stimulus program, all of the dislocations caused by COVID are going to slowly work through the system. I don't know how fast it's going to be. It's going to be painful. It's going to continue to be inflationary. But as we adjust to that, there will be less volatility around that. So I think 2023 is going to be looked at as the year in which volatility declined from the system, and I think that's going to be a sigh of relief to corporate treasurers.
The year of declining volatility, not no volatility, but declining or reducing.
Well, I'm an options guy, so I love volatility. In the long run, that's excess volatility is not a good thing.
So, Tony, in the latter portion of 2022, the popularity of supply chain financing seemed like it started growing significantly. Based on some of the things you're saying, what do you see as the outlook for supply chain financing activity? What are the upward drivers and any downward drivers? What's your view on that?
Craig, looking at this, obviously you've got improving technology supports all this, and we'll just stipulate that as a given.
Economics,
yeah. But if we look at the pure financial economics of this, as interest rates rise and the economy slows, credit spreads widen, and less creditworthy companies will see a faster increase in borrowing costs than more creditworthy companies. The economic rationale of supply chain finance is that there is a higher creditworthy company in the chain that can borrow and finance the less creditworthy companies in the chain. So as credit spreads widen, supply chain finance, by definition, will take off. I mean, the economic pressures will require that. The other factor, though, is as the central banks reduce the size of their balance sheets, what they're doing is reducing the money supply by reducing bank excess reserves, which at some point will make banks less likely to lend, and therefore credit spreads widen even further and put even more pressure or create more opportunity for the highest creditworthy companies in the supply chain to finance the rest of their supply chain. So, I think we're going to see a golden age of supply chain finance, to be honest with you.
Yeah, the two biggest drivers are all in one direction. We see a lot of indications on the access to capital already starting to do what you're suggesting. or what you're saying is likely, as well as the outlook in 2023. We just completed some research, and it shows both banks and corporations seeing the balance, let's say the balance of power shifting to the lender side. Very, very heavy, a big swing. We'll share more on that later, but that aligns exactly with what you're saying. So the 2023 is a golden age of supply chain financing and a year of declining volatility. Excellent points, Tony.
They're not kind of household sound bites, but we're in a really complicated period where there are macroeconomic pressures that are driving things, and there doesn't seem to be an appreciation of how insidious inflation is and how almost impossible it is to stamp out in a reasonable time frame unless all of the drivers are moving in the right direction. And that's absolutely not the case today.
Yeah, thank you. Thank you so much, Tony.
Well, thank you, Craig. It'll be an interesting year. Let's make a date to come back and review this.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.